Hi, it's Lee and welcome to the Tesla Economist. So Elon says the next 12 months may still be challenging, and then hopefully after that, he expects to see the economy start to recover. Now you might think that he's more credible than many of you when it comes to predicting what will happen in the economy, and has a pulse on things in real time. But in reality, not even Elon can tell the future. We still don't know how the economy will go. History generally teaches us that an economic slump is often around 2 years. But funny things can happen. Anyway, in this video, I just wanted to work out how much lower Tesla's car prices could go, and yet Tesla would still be at break-even in earnings. Although free cash flow would however be negative due to Tesla's substantial CAPEX, which we can talk about too. Now, firstly, I'm just talking about financials for Tesla over this time. It's one thing trying to predict what's happening in the economy or what's going to happen with Tesla's earnings. However, those two elements can be irrelevant as to what could happen to the stock price. If the market feels like Tesla is going to win in AI or FSD or EVs, then Tesla's stock price could still run. There can still be a total disconnect between them all. Also, in the environment we are going to simulate, where Tesla have to lower their prices again, then this will of course be as a result of aggregate demand for autos dropping too, which would imply that Tesla's auto market share is actually increasing during this time. If it's bad for Tesla, then it's bad for everyone, or potentially worse for everyone else. Why would it be worse for everyone else? Because, like we said, Tesla would have lowered their prices and thus eating more market share, taking more sales away from legacy. Alright, so let's take a look at some numbers and get an indicative idea of roughly what sort of price Tesla's cars will be lowered to and still run at break even. If we take total auto revenue and divide it by deliveries, we get an ASP of $46,000. This doesn't include regulatory credits, but does include leases, etc. But like I said, this is just going to be indicative and will give us a good enough idea of what we're dealing with here. When we take in all the costs, we have a $3.7 billion gross profit with a 19% margin for autos. Then we look at Tesla's income before taxes, and it comes to $2.8 billion. Therefore, if Tesla's gross profit for autos dropped by $2.8 billion, then Tesla would then be operating at break even. I think the numbers are that simple. We don't need to factor in other sides of the business. Okay, sure, we do however expect the other sides of the business to grow in profit and likely compensate for any further auto losses over time, but we can't guarantee what that growth will be like. This would mean that if Tesla lowered their prices all the way to earnings being zero, then the auto revenue would then become $16.6 billion. The ASP would then come down to $39,000 from $46,000, which is a 14% drop in price. So that's the number we wanted. We'd be looking at something like a 14% drop in price for Tesla's cars, and for the company to still function at break even. That would mean a Model 3 in the US would start at just under $35,000, and a Model Y would start at just under $40,000. And those prices don't even factor in the tax credit, which I think we can all agree is a ridiculously low price for a Tesla. And as we know, there is a much larger pool of demand from every incremental price drop at this stage. For example, before, when Tesla's prices were higher and the prices dropped 10%, demand might have increased by 20%. But at this stage, if Tesla drops prices by 10%, then demand may increase by 40%, just as an example. For a start, the economy would have to be in seriously bad shape for Tesla to drop prices this much further again. But it's good to know that even at these prices, then Tesla still won't lose money. Well, not lose money on costs of goods sold. There's still the matter of cash flow. Tesla is a growth company, and it's a growth company that produces cars. Cars are a very capital-intensive industry. Tesla is trying to grow at rapid rates and double production rates in the next couple of years. The factories are so big, they are literally the biggest factories in the world. Well, these factories cost money. Last quarter, there was over $2 billion in CAPEX. That is not nothing. Yes, Tesla managed to make enough profit to cover that, but it only left $441 million of free cash flow for the quarter. We just worked out how much Tesla could lower prices for break even on earnings, but Tesla would still need to keep growing and spending money on said growth. For Tesla to remain cash flow positive, the prices of cars could only drop 2%. Any lower than that, and they would have to dig into reserves. So if things got really bad and Tesla was operating at break even, there would potentially be about $2 billion of negative cash flow each quarter. However, Tesla have the reserves and could still last more than 2 years running at that state, which would make you wonder, if it's this bad for Tesla, then surely many of the competition would not outlast and go under before then, or there would be bailout to go around, of which Tesla would also likely benefit. Also, some of that CAPEX is going to be moved into cost of goods sold soon, when a lot of these facilities Tesla are building come online, things like the new cathode factory in Texas. On top of that, the Cybertruck line will also be removed from CAPEX soon and go into cost of goods sold when it starts production. This actually will affect earnings and margins a noticeable amount, but will actually increase free cash flow, as there would have been reduced CAPEX as the line is complete, and a little bit more income from Cybertruck sales too. Of course, there's a lot more CAPEX to come as well, when Tesla starts Mexico and Megapack Shanghai and potentially the Giga Nevada expansion. Tesla bears like to bring up the CAPEX issue that Tesla has, but I think Tesla can weather this still, even if the economy makes another turn for the worse. I don't think Tesla will need to drop prices by as much as we said and go down to break even. Those prices seemed ridiculously low, and like I said, if it got that bad in the economy, then there'd be some intervention somewhere to support Legacy and Tesla. Even a further 5% price drop would still mean Tesla can likely last years. But hopefully there is only a further 12 months of this to deal with, and we don't see any major financial crisis in the meantime. Looking at these numbers though, it looks like Tesla will be fine to continue their growth through struggling economic times. Anyway, I wanted to entertain this, as this is an argument that many bears raise. But the point is, like I said, Tesla are planning on doubling their growth over the next 2 years or so. That does require a lot of CAPEX. But that CAPEX is high relative to where Tesla are today. In addition to that, it's high relative to where the economy is today, and with higher rates eating into Tesla's profits. Eventually, there'll be more economies of scale kicking in, and a lot of these current CAPEX will be wrapped up, starting to produce profits. Hopefully even the likes of 4680 cells too. And with new manufacturing techniques that we'll see come out of Mexico, the margins will be higher, so we will see a relatively higher return on asset or CAPEX. It will take time, but over a couple of years, the CAPEX to earnings ratio will dwindle as Tesla expand more and become more profitable with increased efficiencies and new technologies. And I'm not even factoring in FSD or other such technologies. This is solely EVs and manufacturing. We can't expect massive growth without high CAPEX, especially with an auto company. I can't see Tesla running at a loss, but if things do get tight, there may be some quarters with some negative cash flow. But Tesla have enough of a cash buffer to see that through for some time. And remember, eventually CAPEX turns into profits, like we should see sometime next year with the Cybertruck. Tesla can survive this storm, and likely any other, it will continue to innovate and grow, and will come out the other side bigger, leaner, and stronger. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.